Welcome back, everybody, to Haas and Dawe's podcast known as Debits and Credits with Haas and Dawe, and we're ready to go on with a new episode today. Good morning, and welcome to what we're going to talk about with income taxes. Very important part of a CPA firm's business, and one that terrifies clients sometimes more than they realize it really should. We're going to focus today on what came out last July, what's known as the One Big Beautiful Bill. Honest to goodness, that's the name of the bill. One Big Beautiful Bill, which just came from the Congress and from the White House with a lot of measures that they wanted to go forward with. But what's interesting about this tax bill, it had two main focuses. One, a lot of what happened back in 2017 had to be extended because these provisions were known as having sunset provisions, so that they would be expiring. And so Congress knew they had to pass a bill this year, and back in 2025, to keep these provisions going forward, or to change them, or to make them permanent. One other thing that came about with this bill was the deficit. As you probably all know, the deficit we have in this country is growing and growing. We have not had a balanced budget since 1996, believe it or not. And so what's happening is they were very concerned about not letting the deficit get any bigger. And what happens with tax bills is they have these provisions known as budget neutrality, where they can raise revenue, but if they're going to raise revenue, they have to be able to give something back. Or if they're going to give something back, they have to be able to raise some revenue to be able to keep the deficit not growing. And one of the biggest provisions that the White House wanted with this tax bill was to cut the corporate tax rate again. And Congress said, well, if we do that, it's going to create another $7 trillion in deficit. So that provision went away. What happened, though, in the bill is that there was more focus on individual income tax and not doing much on the corporate income tax side. And so when we talk about the One Big Beautiful Bill, colloquially known as OBA, we're going to talk about some provisions that are affecting individuals that started in 2025 and some are effective in 2026. And this is a help to the market share or the marketplace going for people to do investing, and so that their taxes were not going to be on the increase. A couple of things that went on were they have something known as a standard deduction. In individual income tax preparation, people either can itemize deductions where they claim medical expense, taxes, property taxes, they claim mortgage interest, they can claim charitable contributions, or they can say if they don't have enough of those deductions, they have what's known as a standard deduction. Now, for an individual, the standard deduction is about $16,000, and for a married filing joint couple, the standard deduction is about $32,000. Now, what's interesting also, once you get out of California, which is obviously a very high cost of living state and a high income tax state, 90% of the taxpayers in the country don't itemize deductions anymore. They all come under the standard deduction. And so what the bill did, it came up with an inflationary increase for the standard deduction. So as cost of living goes up every year, the standard deduction will go up. But also it was wanted to do something for seniors. Those are all of us age 65 years or older. And so what they've done is they've created a new additional standard deduction of $6,000 per person for senior citizens age 65 years and older. Now, part of this deduction has some limitations based on overall income, but it's still something to benefit the seniors in the country so that their income tax burden does not become too heavy. Another big provision that got a lot of news time was no tax on tips. And what this is for people who are paid tips in their jobs, and the most common one are servers in restaurants, or people who work at some other service provider facilities, such as car washes, where tips are being given to them, that there's no tax on the first $25,000 of tips that a person receives in any one given year. Now, what's interesting about this, though, is that it's not just, well, if someone leaves a tip on, let's say, on a restaurant bill, that tip is going to be excluded. The tip has to be voluntary. And there are certain rules that came into place as to what's a voluntary tip. For example, if you have a situation where you go to a restaurant, and it's very common where they say if you have more than 10 people in your party, there's going to be an automatic tip of 18% added to the bill. That's not a voluntary tip. Therefore, whoever receives that tip is not going to be able to exclude it from income. But if you have a situation where you just get your bill from the restaurant and you just add a tip onto it, that is counting as a tip that is subject to exclusion from income. Or if you get the ones now they put down, well, 15% is so much, and 18% is so much, and 22% is so much, etc. Well, the 15% would not be excluded, but anything above the 15% would be. So let's say someone receives an 18% tip, 3% of the tip would be excluded from income. And so it's up to $25,000 in total tips. And again, there's certain income limitations that have to be taken into consideration. Another exclusion to income that was introduced this year with this tax bill has to do with overtime, and where there's no tax on overtime, and it's up to $12,500 for an individual, or up to $25,000 if they're filing a joint tax return. Now, this is different than the no tax on tips. No tax on tips is up to $25,000 total, whether it's a married couple or a single person. But for overtime, if it's your single person, the first $12,500 of overtime is included. Or if it's a married filing joint return, the first $25,000 of overtime. Now, what overtime is defined at, it's not the total amount of overtime, it's the half time, meaning if you get time and a half for overtime, it's the additional half time that's excluded. Or if it's a situation where you're getting double time, it's just the extra time on top of the straight time that's excluded. And again, there's certain limitations relative to income as to when the overtime amounts are excluded. Now, it makes it interesting because the reporting of overtime, particularly for 2025, was something that was because the bill got passed so late in the year, and the IRS had already designed the W-2 form. There's no box on the W-2 to show overtime. And so it's almost like a voluntary situation for 2025. If the employer wants to or can put it onto the W-2, they can, but they're not required to. All they would have to do, though, is provide some sort of statement, whether it be a pay stub or some other type of bulletin to the employee saying this is what your overtime was for 2025. Now, in 2026, there will be a box on the W-2 showing what the overtime amount is and the amount that's subject to the reporting, so that the exclusion can come into place. Now, it's interesting, though, because you look at it from a bizarre standpoint of, well, are people going to say, can you please just code my time as overtime versus regular wages, or if the way they get paid, so it's more specifically geared toward overtime? We'll see what comes about with that. It'll be interesting how the payroll services and how the employers can put that together. Another item that came about that was bringing something back onto tax returns for 2026 is going to be car loan interest. Because up until the last how many years, they took away personal interest off of the tax returns. We're talking about almost for 40 years. You cannot deduct personal interest anymore in tax returns, just mortgage interest. But now they're saying because the cost of cars are so high, and pretty much everybody gets a car loan when they buy an automobile, that they're saying that will allow car loan interest up to $10,000 in any one particular year. Now, what it is, it has to be a personal car. It can't be used for business. It has to be assembled in the United States, meaning the last part of the assembly of that car has to be done in the United States. And also the car has to weigh less than 14,000 pounds. And then it's for a loan entered into during 2025, but the loan has to be from purchasing the car. It can't be on something where that you've already had the loan and now you can start doing it. If a loan for a car that's just being purchased now, and it's something where the dealers are going to be producing a new 1099 form showing the car loan interest. So these are the major provisions that came about with these taxes for 2025, and some of them for 2025, some of them for 2026. And what's also interesting when you look at tax legislation, they say because they did some of these provisions that were sunsetting, that were known as temporary, they said we're going to make it permanent. We're going to make the tax rates permanent, because they did not raise any tax rates for 2020 with this bill in 2025. They did not raise the estate tax rate. They made certain things permanent. Well, permanent only means until the next time Congress gets together and changes the bill or changes the law, or if one of these provisions comes before a court of law and they rule that it's not constitutional, then the permanency goes back to being temporary as well. And so we'll see what happens in the next year or two. We know that come this November, there's going to be midterm elections, and we'll see what happens in the makeup of Congress and the Senate. There's a lot of people who think that perhaps that because it's a midterm election, and throughout our history, it's very normal to see that the party that got elected during the presidential election loses seats during the midterm elections. We'll see what plays out in 2026 come November. And if there is a change in the House and a change in the Senate, will that mean there'll be more legislation coming our way to do some more with taxes? Because keep in mind that the national debt is very huge. The amount of money we pay as a country on interest on our debt is our second biggest budget item. So it's definitely in the minds of people in Congress and in the Senate to try and keep that under control. So that's what went on with the one big beautiful bill that passed in July of 2025. That'll be affecting your taxes in 2025 and for sure in 2026. And as a new develops happen, we'll be more than happy to pass those along. Stay with us for our next episode of Debits and Credits with Haas and Dawe as we explore more items in the area of tax and accounting and what's affecting you in your day-to-day personal and business lives. Goodbye for now.